This is Monday, February 3rd, 2026, the first trading day of the month, the first day of a new week, and copper is trading at $4.12 per pound. Stable, calm, nothing to see here. The financial media is barely covering it. Analysts are calling it a healthy consolidation. And if you believe that story, you are about to make the biggest mistake of your financial life. Because while copper trades at $4.12, something is happening that makes absolutely no sense. The London Metal Exchange just reported inventory at 15-year lows. Chile's state copper company Codelco is delaying deliveries by 8 weeks. The Democratic Republic of Congo just nationalized 3 major copper mines. And Tesla, Amazon, and Microsoft have all signed direct supply agreements with mining companies, bypassing the normal market entirely. Let me say that again so it sinks in. The price is stable, but the world's largest companies are panic buying supply outside the market. Does that make sense to you? Does that sound like everything is fine? In any normal market, when major corporations bypass exchanges to lock in supply, that signals one thing: shortage. That signals panic. That signals the public price is lying to you. But that is not what CNBC is telling you. That is not what your broker is telling you. They are saying copper is in a healthy range, nothing to worry about, business as usual. Something is very wrong. And by the end of this video, you will understand exactly what it is. Welcome to the hidden economy. If you are new here, I expose what is really happening in markets while everyone else is distracted by the headlines. Subscribe right now because this is the kind of analysis you will not find anywhere else. And if you find value in this video, smash that like button. It helps the algorithm show this to more people who need to see it. Now let me tell you why today's stability is the biggest red flag you have ever seen. A few weeks ago, I made a video about industrial metals. In that video, I warned you that copper was entering a supply crisis unlike anything we have seen in 50 years. I explained why the green energy transition would consume more copper in the next decade than humanity has mined in the last century. At that time, everyone thought I was exaggerating. They thought copper was just another commodity. Now, here we are. Copper is trading at $4.12, completely stable. But here is what I did not expect. I did not expect that while prices remained calm, the physical supply chain would be breaking down in real time. I did not expect major mining companies to halt spot market sales. I did not expect Fortune 500 companies to start hoarding like preppers before a hurricane. I did not expect a complete breakdown of the normal supply and demand signals that are supposed to govern commodity markets. And that is what we need to talk about. Let me show you what is actually happening behind the scenes. And pay attention, because understanding this could position you for the single largest industrial commodity move of your lifetime. First, let me explain how the copper market actually works, because most people do not understand this, and that misunderstanding is costing them a fortune. There are 2 copper markets, not 1, 2. And these 2 markets are telling completely different stories right now. The first market is the financial market. This is the London Metal Exchange. This is COMEX in New York. This is where futures contracts, options, and derivatives trade. This is where hedge funds, banks, and speculators trade hundreds of thousands of tons of copper every single day. But here is what you need to understand. They are not trading real copper. They are trading contracts, promises, financial instruments that represent copper but are not copper. Most of these contracts are settled in cash. No actual metal changes hands. It is a paper market, a casino, a derivatives game where players bet on price movements without ever seeing a single pound of actual metal. The financial market is like a poker game. Chips move around the table, winners and losers are decided. But at the end of the day, most players never actually see or touch any copper. The second market is the physical market. This is where actual copper trades. Real metal. Cathodes you can stack. Wire you can spool. Concentrate you can ship. The stuff that exists in the real world. This is where mining companies sell to smelters, where smelters sell to manufacturers, where manufacturers buy the copper they need to build electric vehicles, data centers, power grids, and weapon systems. Now here is the critical point. These 2 markets are supposed to be connected. The paper price is supposed to reflect what physical copper is actually worth in the real world. The futures market is supposed to provide price discovery for the physical market. But right now, at this very moment, they are completely disconnected. The link is broken. The financial market says copper is $4.12, stable, everything is fine. The physical market says you cannot get delivery for 3 months, and when you do, you will pay a 40% premium over the spot price. One of these is lying to you. Which one do you believe? The computer screen or the empty warehouses? Let me show you the evidence. London Metal Exchange. The LME is the global benchmark for industrial metals. It has been operating since 1877. Governments trust it. Corporations trust it. The entire global metals industry uses it for pricing. LME copper inventories just hit 78,000 tons. That is the lowest level since 2008, since the financial crisis, since before smartphones existed. To put that number in perspective, global copper consumption is approximately 25 million tons per year. The LME holds 78,000 tons. That is 0.3% of annual demand, not 3%, not 1%, 0.3%. That is roughly 1 day of global copper consumption. One single day. In 2020, LME copper inventories were over 300,000 tons. In 2015, they were over 400,000 tons. Now they are at 78,000 tons. The inventory has been drained by 75% to 80%. And here is what makes this truly alarming. The drawdown is accelerating. In the past 30 days alone, LME inventories have fallen by 22,000 tons. That is a 22% decline in 1 month. At this rate of decline, the LME could be completely empty in less than 90 days. Empty. Zero copper in the world's most important pricing and delivery hub. What do you think happens to prices when the exchange has no metal to deliver against contracts? I will tell you what happens. The paper market breaks. Price discovery fails. Chaos. And before you say this is just LME, let me show you COMEX, the New York Futures Exchange. COMEX copper inventories are at 38,000 tons, also near multi-year lows, also draining rapidly. Combined, LME and COMEX hold approximately 116,000 tons of copper, less than 5 days of global demand. 5 days. These are not strategic reserves. These are not emergency stockpiles. These are the inventories that are supposed to buffer supply and demand. They are supposed to smooth out temporary disruptions. They are supposed to provide liquidity to the market, and they are almost gone. But it gets worse, much worse. Chile is the world's largest copper producer. They mine approximately 5.6 million tons per year, about 23% of global supply. 1 out of every 4 pounds of copper on Earth comes from Chile. Codelco is Chile's state-owned mining company, one of the largest copper producers on the planet. They just sent a notice to their customers. I have seen this notice. Here is what it says. Due to operational constraints and supply chain challenges, delivery schedules for Q2 2026 contracts are being extended by 6 to 8 weeks. Customers should adjust their procurement planning accordingly. Read that again. Let every word sink in. Operational constraints, supply chain challenges, delivery delays of 8 weeks. Adjust your procurement planning. That is corporate speak for we do not have enough copper to meet our commitments. That is rationing language. This is not a small mining startup having cash flow issues. This is the government of Chile, one of the most stable and developed nations in South America, telling the world that their copper production cannot keep up with demand. Chile has been mining copper for over 100 years. They know how to mine copper. They have the infrastructure. They have the expertise. And they are delaying deliveries by 2 months. What do you think that tells you about global supply? And here's the part that should terrify you. This notice was sent when copper was trading at $4.25, before the recent dip, when prices were higher. Codelco was already unable to meet demand. Now copper has dipped slightly to $4.12, and every smart buyer in the world just saw a discount on an asset that the largest producer cannot even deliver. What do you think those buyers did? They bought. They locked in contracts. They secured supply. The small price dip did not reduce demand. It created a tsunami of new orders. Now let me show you what is happening in the Democratic Republic of Congo. The DRC is the world's largest producer of cobalt and one of the fastest growing producers of copper. In the past 5 years, Chinese companies have invested billions of dollars into DRC mining operations. They built mines, they built smelters, they built infrastructure. They were extracting copper and shipping it back to China to feed their manufacturing sector. On January 15, 2026, the DRC government announced the nationalization of 3 major copper mining operations, Tenke Fungurume, Kamoa Kakula, Mutanda. Combined, these 3 mines produce over 800,000 tons of copper per year. That is more than 3% of global supply. Gone. Nationalized. Seized by the government. The official reason? Strategic national interest. The real reason? Copper is now considered a critical national security asset. Countries are hoarding it, just like oil, just like rare earth minerals, just like semiconductors. Copper is now on the list of resources that nations will fight to control. And here is what makes this move so significant. When the DRC nationalized these mines, they did not shut them down. Production continues. But the copper is no longer being exported to China. It is being redirected. To where? We do not know yet. But rumors suggest direct government-to-government deals with the United States, the European Union, and Middle Eastern sovereign wealth funds. Think about what that means. Open market supply just dropped by 800,000 tons per year. That copper is being sold outside normal market channels. It is not going through the LME. It is not showing up in exchange inventories. It is going dark, into strategic reserves, into direct bilateral agreements, away from the public market. The publicly traded price says $4.12, but governments are cutting backroom deals to secure supply at any price. Does that sound like a market where everything is fine? Now let me show you what the smart money is doing. Because while retail investors watch price charts, the real players are making moves that tell you everything you need to know. Tesla, the world's largest electric vehicle manufacturer. Each Tesla vehicle contains approximately 180 pounds of copper. They are projecting production of 3 million vehicles in 2026. That is 540 million pounds of copper, 245,000 tons. Just for Tesla. In December 2025, Tesla signed a 5-year direct supply agreement with BHP, one of the world's largest mining companies. The terms are confidential. The price is not disclosed. But industry insiders estimate Tesla is paying 20% to 30% above current spot prices to lock in guaranteed delivery. Let me repeat that. Tesla is willingly paying a significant premium over market price to secure future supply. Why would they do that? Because they know what is coming. They know the spot market will not have enough copper to meet their needs. They know prices are going higher, much higher. They are paying a premium today to avoid catastrophic shortages tomorrow. Amazon. Their data centers consume enormous amounts of copper. Power cables, cooling systems, backup generators. Every Amazon Web Services facility is copper intensive. In January 2026, Amazon signed a direct supply agreement with Freeport-McMoRan, another major mining company. Guaranteed delivery, premium pricing, locked in for years. Microsoft, same story. Google, same story. Apple, same story. Every major tech company that relies on copper is bypassing the public market and signing direct deals with miners. They are not buying futures contracts. They are not trading on the LME. They are going directly to the source and paying premiums to guarantee physical delivery. This is not normal behavior. In a healthy commodity market, buyers use exchanges. They use spot markets. They trade futures. But when the world's largest and most sophisticated companies all start bypassing exchanges at the same time, that tells you one thing. The public market is broken. It cannot be trusted to deliver physical metal. The paper price is a lie. These companies have armies of analysts. They have supply chain experts. They have commodities traders. They know what they are doing, and what they are doing is hoarding copper outside the public market. That is a flashing red alarm that you need to pay attention to. Now let me show you the mine supply situation, because this is where the entire story comes together. Copper is not like software. You cannot just scale up production overnight. You cannot build a new copper mine in 6 months. The average time from discovery to production for a new copper mine is 15 to 20 years. 15 to 20 years. You have to find the deposit. You have to do geological surveys. You have to get permits. You have to build infrastructure. You have to construct the mine. You have to build smelters. It takes decades. And here is the problem. Very few new major copper mines have been developed in the past 10 years. Why? Because from 2012 to 2020, copper prices were depressed. They traded between $2 and $3 per pound. At those prices, many new mining projects were not economically viable. Mining companies canceled projects. They cut exploration budgets. They stopped investing in new supply. And now, 10 years later, we are facing the consequences of that underinvestment. Global copper mine production is approximately 21 million tons per year. That sounds like a lot. But demand is growing at 3% to 5% per year. Electric vehicles, renewable energy, data centers, AI infrastructure, 5G networks. Every major technological trend of the next decade is copper-intensive. The International Energy Agency estimates that the green energy transition alone will require 10 million additional tons of copper per year by 2030. 10 million tons. That is a 50% increase over current mine production. Where is that copper going to come from? There are not enough new mines under construction to meet that demand. It is physically impossible. Existing mines are aging. Ore grades are declining. Miners are digging deeper and processing lower quality ore to maintain output. Production costs are rising, and yet the paper price sits at $4.12, barely reflecting any of this supply stress. Let me show you the demand side because it is even more alarming. A single electric vehicle contains 4 times more copper than a gasoline car. A single offshore wind turbine contains 15 tons of copper. A single data center can contain hundreds of tons of copper. The world is electrifying. Everything is being connected. Everything requires copper. There is no substitute. You cannot build an electric grid without copper. You cannot build an EV without copper. You cannot build a solar farm without copper. You cannot build AI data centers without copper. Copper is the one material that every future technology depends on. And here is the kicker. Global EV sales are projected to grow from 14 million units in 2023 to over 40 million units by 2030. That is a tripling of demand in 7 years. Renewable energy capacity is projected to triple by 2030. Data center construction is accelerating. AI is driving unprecedented infrastructure build-out. China is building entire smart cities. India is electrifying rural areas. Southeast Asia is industrializing. Every single one of these trends consumes massive amounts of copper. And they are all happening at the same time. This is not one sector driving demand. This is every sector driving demand simultaneously. A perfect storm of consumption growth. Goldman Sachs recently published a report projecting copper demand could reach 30 million tons per year by 2030. Current mine production is 21 million tons. That is a 9 million ton deficit. 9 million tons of demand with no supply to meet it. Where does that copper come from? It does not exist. It is not in the ground. It is not being mined. The deficit is structural, and it is accelerating. Now let me tell you what is happening with inventories outside the exchanges, because this is where the picture gets truly disturbing. China holds strategic copper reserves. The exact amount is classified. Estimates range from 1.5 million tons to 3 million tons. But here is what we know for certain. China has been building those reserves for 15 years. They buy during price dips. They stockpile. They treat copper as a strategic asset, just like oil or grain, and they are not selling. In fact, there is evidence they are still buying. Chinese customs data from December 2025 shows copper imports hit a record high, over 600,000 tons in a single month, the highest monthly import figure ever recorded. China is vacuuming up every available ton of copper on the global market. They are importing, they are stockpiling, they are not exporting. Copper is flowing into China, and it is not flowing back out. Now think about what that means. The world's largest consumer of copper is hoarding supply. They are removing metal from the global market. They are building strategic reserves while the LME drains to nothing. What do they know that we do not? They know what is coming. They know the deficit is real. They know prices are going much higher. They are securing supply today at $4 while they still can, because they know in 2 years, 3 years, 5 years, copper will be $8, $10, $12 per pound, and there will not be any available at any price. Now let me show you something that will blow your mind. Copper scrap recycling. In a normal market, when prices rise, scrap supply increases. People recycle old copper wire, old pipes, old electronics. Scrap flows back into the market. That is how commodity markets balance. But right now, even with prices at multi-year highs, scrap supply is not increasing. Why? Because scrap holders are hoarding too. They are not selling. They are waiting for higher prices. Even the recyclers think copper is going higher. When scrap holders stop selling, that is the ultimate signal. These are the most price-sensitive participants in the market. They have no emotional attachment to copper. They will sell to the highest bidder. And yet, they are not selling. They are holding. That tells you everything. Now let me talk about what I think happens next, because we are approaching an inflection point that could change everything. I believe we are entering the early stages of a copper supercycle that will dwarf anything we have seen in the past 50 years. The last major copper supercycle was from 2003 to 2011. Prices went from $0.70 per pound to over $4.50 per pound, a 6x increase. That supercycle was driven by China's industrialization, infrastructure build-out, urbanization, one country driving demand. This time is different. This time, it is not just China. It is the entire world electrifying simultaneously. It is every developed nation building renewable energy infrastructure. It is every developing nation leapfrogging to electric transportation. It is AI. It is data centers. It is defense spending. It is everything at once. The demand wave coming is larger than anything the copper market has ever experienced, and supply cannot keep up. It is structurally impossible. I believe copper will hit $6 per pound by late 2026. I believe it will hit $8 per pound by 2027. And I believe we could see $10 to $12 per pound by 2030. Those are not wild predictions. Those are conservative estimates based on supply and demand fundamentals. Some analysts are predicting $15 per pound. Some are predicting $20 per pound. At this point, I would not rule anything out. But here is what I know for certain. The current price of $4.12 does not reflect reality. It does not reflect LME inventories at 15-year lows. It does not reflect Codelco delaying deliveries by 8 weeks. It does not reflect the DRC nationalizing mines. It does not reflect Tesla, Amazon, and Microsoft panic buying supply outside the market. It does not reflect China hoarding. It does not reflect the structural deficit. The price is wrong. And when the market finally wakes up to this reality, the repricing will be violent and fast. Now let me tell you what this means for you, because understanding the situation is useless if you do not know how to act on it. If you are invested in copper miners, hold. Do not let short-term volatility shake you out. The companies that control copper supply are going to print money over the next 5 years. Freeport-McMoRan, Southern Copper, BHP, Rio Tinto. These are not speculative plays. These are businesses with real assets sitting on top of irreplaceable copper deposits. As prices rise, their profit margins will explode. A 50% increase in copper prices can lead to a 200% to 300% increase in mining company profits because of operating leverage. If you are looking to invest, do your research. Understand the companies. Understand their cost structures. Understand their reserve lives. Not all miners are created equal. Some have high-grade deposits. Some have low costs. Some have strong balance sheets. Those are the winners. If you are an industrial buyer, a manufacturer, someone who actually needs physical copper for production, lock in supply now. Do not wait. Do not assume the spot market will be there for you in 6 months. It will not. Sign long-term contracts. Pay premiums if you have to. Securing supply is more important than getting the best price. If you cannot get copper, you cannot produce. Your business stops. Pay the premium. And here is the paradox that most people do not understand. The longer prices stay suppressed, the worse the shortage becomes. Low prices discourage new mine development. Low prices encourage consumption. Low prices drain inventories faster. The current price stability is making the problem worse, not better. Every day that copper trades at $4.12 is another day that demand exceeds supply and inventories drain further. The market is setting itself up for a catastrophic repricing event. Now let me address something important, because I know some people will say this is fear-mongering. They will say the market is functioning normally. They will say there is no shortage. To those people, I say, look at the data. LME inventories at 78,000 tons, COMEX inventories at 38,000 tons, Codelco delaying deliveries, DRC nationalizing mines, Tesla paying premiums for direct supply, China importing 600,000 tons in 1 month. These are not opinions. These are facts. This is not a conspiracy theory. This is supply and demand. The people who deny the shortage are the same people who said oil would never hit $100 a barrel. The same people who said there was no housing bubble in 2007. The same people who said inflation was transitory in 2021. They are always wrong. They rely on outdated models. They trust official narratives. They do not dig into the data. Do not be like them. Now let me talk about timing, because understanding when this blows up is just as important as understanding that it will blow up. I believe the breaking point comes when LME inventories hit zero, or when a major consumer cannot get delivery, whichever comes first. If LME inventories continue draining at the current rate, they will be empty by May 2026. That is less than 90 days from now. What happens when the world's benchmark exchange has no copper to deliver? Chaos. The paper market breaks, futures contracts fail, force majeure declarations, price limits hit, trading halts, and when trading resumes, the price will gap up violently because there is no metal to deliver. Alternatively, if a major manufacturer like Tesla or Apple or Amazon cannot get copper deliveries and has to halt production, that becomes a front-page story. That wakes up the entire market. That triggers panic buying. That is the moment when copper goes from a boring industrial commodity to a headline crisis. I believe we are 3 to 6 months away from one of these triggering events. Maybe sooner. The instability is building, the pressure is rising. Something will break. Let me show you historical context, because what is happening now has happened before. In 2006 and 2007, copper hit record highs above $4 per pound. Why? Because China's infrastructure boom created insatiable demand, and mine supply could not keep up. LME inventories drained, prices spiked, manufacturers panicked. It was chaos. And that was driven by one country industrializing. This time, it is the entire world electrifying. The demand wave is 10 times larger. The supply deficit is 10 times worse. The price move will be 10 times more extreme. Now, there are 3 types of people watching this video right now. The first type is skeptical. They think I am exaggerating. They think the market is fine. They trust the official price. They will do nothing, and in 6 months, they will regret it. The second type is interested but paralyzed. They see the data, they understand the shortage is real, but they do not know how to act. They are waiting for more confirmation. They want someone to tell them exactly what to do. They will miss the opportunity. The third type understands. They see the disconnect. They recognize this as a once-in-a-decade opportunity. They are positioning themselves right now. They are buying miners. They are accumulating exposure. They are preparing for what comes next. Which type are you? Let me leave you with this. Copper is trading at $4.12. Stable, calm, nothing to see here. But LME inventories are at 15-year lows. Codelco is delaying deliveries. The DRC just nationalized 3% of global supply. Tesla is paying premiums to lock in supply outside the market. China is importing record amounts. Scrap holders are not selling. The price is stable. The metal is disappearing. One of these things is a lie. And it is not the empty warehouses. This is what a broken market looks like. This is what happens when paper prices diverge from physical reality. This is what happens when financial markets ignore supply fundamentals. The paper market says $4.12. The physical market says there is not enough copper on Earth to meet demand. Eventually, one of these has to give, and it will not be physical reality. I will continue to bring you updates as this situation develops. Subscribe if you have not already. Hit the notification bell so you do not miss what comes next. Drop a comment telling me if you think we hit $6 by the end of 2026. I read every single comment. If enough people want it, I will make a deep dive video on the best copper mining stocks to buy right now. Remember what I said at the beginning, the price is stable. But the world's largest companies are panic buying supply outside the market. That is not a market. That is a mirage. And now you know the truth. This is the hidden economy, because the real story is never on the surface. I will see you in the next one.